Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. Obviously, I'll be sharing some stuff myself as well, and giving my financial opinions as we go through all of it. So I'm going to dive right in, go right into it. If you want to follow me, it's at finding_finance, or you can join the website, our community that we've got building over there, where we talk about investments, individual companies, all sorts of stuff. We've got a Discord channel, and people are actively on the Discord channel as am myself, talking about investing and learning as much as we can about becoming better investors. So, if you want to join, it's discount coupon code right now. So, looking at this, Nobody Special says, according the Magic Government CPI math, your health insurance went down by 34% last month. Full stop. And some of these CPI numbers, I don't know if you should believe them or not, but they can do substitutions, hedonic adjustments that can throw those numbers off. Obviously, he's found something where they said that your health insurance went down 34% last month. I don't know if I would agree with that. My health insurance continues to go up every single month, year, second, whatever I look at it. Any measuring stick, it seems to be going up. The market sees the CPI report as benign. Still, I would say that leading inflation indicators are moving slightly in the wrong direction. My CPI model has CPI close to 3.5% year over year in Q2 2024. Too high for the Fed. It's been fairly correct so far. I guess that's his trend model that he's got, and I don't know what he's using, but it looks like it's something to do with the dollar, NFIB, ISM, wages, house food, oil prices, etc. And he's getting around 3.5% for the lagging consumer price index indicator here. There are a few assets that can provide meaningful diversification benefit in a portfolio, particularly from a real return purchasing power standpoint. In an environment where stocks and bonds are so highly correlated, notable to see the low correlation across commodities. This is a really cool chart that even I want to go over myself. This is the correlation to the U.S. dollar. So and the S&P 500. So this is the correlation to the S&P 500. This is the correlation to the U.S. dollar. If you were to look at this, you can see that the majority of these, here's the zero line on the US dollar, and anything to the left is a negative correlation. The only thing that has a slight positive correlation with the dollar would be US natural gas. Everything else has a negative correlation, which means it moves in the opposite direction. If you look at correlation to the S&P 500, more correlated means it's higher up. So aluminum is more correlated to the S&P 500 than, say, something like natural gas or Brent crude or even lumber. And you can use these as a diversification in your portfolio. I am heavily in nat gas, Brent crude. I even have some aluminum, silver, iron ore. It's kind of all over the place, and I'm in a wide array of all these different assets. And for the most part, they're all negatively correlated to the dollar. So what does that mean? It means that when the dollar goes down, these commodities go up. But there are some commodities that are still correlated somewhat to the S&P 500. And if you look, the zero line on the S&P 500 is down here, and these are all somewhat correlated to the S&P 500. Coming on down, we've got, for the first time in nearly 2 decades, interest rates are now comfortably higher than inflation. That is definitely debatable because the inflation rate is a number that is hedonically adjusted, substituted, et cetera, et cetera. This restrictive monetary policy is a throwback to 1980s, 90s, when asset prices were much lower. So he's got interest rates and inflation and how he's got these crossing each other. The only thing that I would say is if you calculate the 1980s consumer price index, you get a value that's over 10%. Uh, that would mean that we actually do not have an interest rate that's more comfortably higher than inflation. We've got inflation that's comfortably higher than the Fed funds rate, and it is not restrictive. Depending on the calculation measuring stick that you use, if it's 1980, we're probably more like 13%, 10 to 13% inflation rate. Just an FYI. Joseph Wang says, as inflation declines, the Fed would cut nominal rates to maintain real rates. Otherwise, policy would be tightening even as inflation declines and growth slows. So generally, when you get a slowing consumer price index number, they're more likely to cut nominal rates or that interest rate's going to fall. What they want to do is they don't want to get too restrictive. And again, what is the real rate of inflation? Difficult to say, but they want to keep a real negative rate. Is what they want to do. They want to inflate the debt away. Michael Gayed says gold, utilities, and treasuries are all warning you that the rally likely won't last. I said very short-term risk on dynamics here, but a rally driven by defensive plays means you're screwed. It's a trap. And one I'm playing in before risk-off returns. So, I mean, that's his opinion. I do think gold's looking really good. That's how I would play it. He's saying a slowdown is obviously coming. That's his opinion. But I think he's been saying that for a long time. So who knows who's right? Mortgage rates heading back into the low sevens. I've seen home builders just ripping it to the upside here. In a slowdown, you generally don't see home builders go up, which goes against this. I would almost say, if it were me, that we might get a temporary move lower with rates. We might see relief in gold start to move on up, and then I think that rates are going to bottom at some point and then move on up. We'll see. So if I were to take a look at that, and I were to show you kind of what I mean, is you can see that we're getting a pullback in interest rates here, and I think that will continue, but I think it's going to come down here and then rally back up. So really what we have here, if you look at it from a big long-term perspective, again, guys, this is just my opinion here. We've got a big breakout of that big trend line, that 40-year downtrend line that we've got. Then I think we're going to pull back, and then I think we're going to get a back test here, and then we're going to move on up again. So there could be a slowdown in the short term, a pullback in interest rates. The thing that is very weird is that that pullback, I think, is going to increase inflation as the home builders look absolutely excellent. This is a Livermore accumulation cylinder, 1, 2, 3, 4, 5, 6, 7. And we've got a whole bunch of movement to the upside here recently. This is on a weekly candlestick. Look at this, how strong this move is. It's almost as if rates were to come down, that the builders are going to accelerate to the upside. That does not scream recession. Does not. So maybe we get a short-term pullback in rates. It reignites the home builders, and then with some lag, we could see inflation come back in another kind of impulse move. The way that he can hold this down is he's going to have to keep rates high for a long time. And I don't know how he's going to do that with the consumer price index, at least the way that they measure it, is declining. So interesting setup here, and this looks like it's ready to go. And obviously, if I take individual companies, some of them are making all-time highs on this. So that is not what happened in 2005. And then we overbuilt in 06, 07, and then we had the crash in 08. And a lot of the crashes are related to weakness in the housing market. My eyes are going to be on XHB. Even KRE is looking a lot stronger the past few trading sessions here, and this looks like it's ready to go up. So if rates continue to go down, like we saw in that 2-year yield that I had up here, if rates do come on down, I think it'll be a short-term slowdown perhaps, maybe, and then we'll see strength in the home builders and banks because they'll have less losses in their bonds. And maybe bank lending kicks up again. And if we get bank lending, M2 money supply comes back, and we get more inflation. If you're not maxing out your 401k, then you're doing it wrong, at least to this guy's opinion. Um, I mean, it depends what tax brackets you're in. I try to do a little bit of everything. Get a Roth IRA, do pre-tax 401k contributions. I do all that stuff. The health savings account also reduces your taxable income, and it depends how much money you make, obviously, and how much you can put in there. But to this guy, if you're not maxing your 401k, then you're doing it wrong, apparently to him. Agreed inflation is no way backing down, and agriculture is one of many signs for that. This is an interesting chart here. This is your DBA, Invesco DB Agriculture Fund. And he called the bear market low back in June of 2020, and it's a proper call, not some vague question mark thing. The narrative now is that inflation is backing down. It is not. E.g., this chart says second inflationary wave is incoming. Get ready. Obviously, here's your big move here. You hit your head on resistance coming across. You've got an inverse shoulder, head, shoulder, which I've seen these things everywhere. They're all over the place in oil, nat gas, and the way that I see it, and is that we could see another huge impulse move higher in inflation. And that is where I think Grady's talking about here. It's an inverse head and shoulder, and we've broken out of this pattern. Everything looks good for that. And I can show you here's oil, just to show you guys what that chart is that I'm talking about. This is a shoulder, a head, and a shoulder with this is it on logarithmic. And if we get a breakout here, this thing's going to be a monster to the upside. The projected price move on this is a land far, far, far away. So what I did is I took this move here, projected it up on top of the neckline, and the projected move is $850. We're trading at 140 right now. And that's on XOP, and it's not just XOP that has this pattern. Obviously, we've got DBA that has it. We've got individual companies all over the place that have this pattern. PSCE, which is another ETF of small caps, also has the inverted head and shoulders, along with a breakout and a back test that is occurring right now, and it's ready to move up to the upside. That price projection is all the way up at 375 from $53. These are some big moves, guys. So I'm in the camp that these guys calling for recessions could be massively wrong, at least for a big one. I think we could get a slowdown in the short term. I get it, but I think that's going to spark even more inflation. That's what these charts are suggesting, at least. Today's inflationary forces are relentless. Agricultural commodities are less than 3% from surpassing the peak levels reached when Russia-Ukraine war broke out. This is another agricultural commodity chart. He's got it probably on logarithmic, and he's got a big downtrend line break, a back test, and here we are heading higher, and that looks really good. You can also put a line across here, and that is what he's talking about, the inverted shoulder that we've developed. And those patterns are just psychological hit points. They're just psychological resistance points. You hit them, you bounce back, hit it again, bounce back, and eventually your lows that when you come back and hit it, they don't go down as much, and the sellers weaken as you get through that resistance level, and then you get a big breakout. So agricultural commodities, we can even look at like soybeans and stuff like that. They all look pretty solid, and they look like they want to go higher. Soybeans, wheat, and all those. And I'll yank a couple out just to show you guys what those look like, since I don't go over them that frequently. So here's cocoa. This thing's just been ripping. And again, I don't know if it'll go straight higher, but we might get a retest and then a big move to the upside again. But this thing's got a huge breakout. We've got wheat. We're back at support for wheat, and there's our support level. So we broke out, came back to support, and now we should be looking to see if we can get some life back into wheat. Soybeans also looking pretty good to move to the upside. Another driver that might move up, and corn It looks like it's just moving sideways at the moment, but it looks like it's trying to base out and turn on higher. And so that's what I'm seeing there for some of these agricultural commodities. The U.S. housing market is extremely unaffordable for the average American. Home prices to median income ratio has just hit 7.4x, signaling that home prices are now more than 7 times the median income. To put this into perspective, the metric reached a peak of just over 6.75x before. What I'm going to say is the shortages in the market could also drive this. It's going to price out all of the people who are the 50th percentile of income earners. It's going to be all top 20% or less, which I think is pretty much normal if you've got a housing market shortage. The average 30-year fixed U.S. mortgage rate ticks down to 7.4%. We're just a hair above this month's low point at 7.38%. So those 2-year yields, the 10-year yields dropping is going to have an impact on mortgage rates. They're also going to fall if the 10-year also continues to fall. Another day, another housing market record. A home buyer must now earn about $115,000 to afford the median priced U.S. home, according to Redfin. This is up 15% since last year and over 50% since 2020. Home buyers need to earn about that amount more than ever before, and there we are. I think if interest rates come back down, it's going to alleviate some of this affordability problem. It may not solve all of it, but it's going to be more affordable to more people at a time when homes are still at low inventory levels in a lot of cities. Home builders are in a secular run, and I think this is kind of important too because it's important to the thesis of the channel, which is new homes, new loans is inflationary. It's a credit expansion phase. Believe it or not, the home builders are not very cyclical. I know that sounds crazy, he tells CNBC. So this is Chris Verone. He says, believe it or not, home builders are not very cyclical. I know that sounds crazy. He says they, the builders, are super duper rate sensitive, aren't they? He says it's funny, not how you'd think historically. That relationship has been much more pronounced in the last year or so, but not really when you look at the life of the data set. They tend to be far more secular. They can go on these big secular 10-year runs. I think we're in a secular home builder run, and every time they sell them, home builder stocks down to you minus 20% or minus 30%, like we had a few weeks ago, take advantage of it. They're good long-term setups. I see the same exact thing when I look at the long-term charts. They're really good long-term setups in the home builders. Just because we don't have enough housing supply, question mark? I suspect that's the secular story here. Remember, we think of '08 as them lending down before, during, and after. But they acted very differently in the slowdown in 2000, 2001, and 2002 that led up to the entire time. So they were going up in 2000, 2001, and 2002. And I can show you a chart. We can pull up Leonard Corp real quick. So let me back way out. So in 2000, 2000, so this is 2000. This is the move that he's talking about. We had a slowdown in the market during this time frame from 98, 99. It came all the way up 2000, 2001. It just kept going up all the way till the peak of 2005 where we rolled over. What do we have today? We've got all-time highs. There it is, punching up. It's got a little bit of resistance. So the home builder, Lennar Corp at least, and a lot of these other home builders, they continue to track higher. Here's DR Horton. That's also basically at all-time highs, closing point. And what we saw in 2000 here, this was the recession, and it just kept going up and up and up and up. This is your secular bull market in home building. We had this big pullback here. That was your crash. Everyone thinks that this is going to occur, but that's not happening. That's not what is occurring. That is not what the data is suggesting. It is suggesting that we are moving higher because we've broken out. We've done our retest, and now we're making a new high. That is not how a home builder reacts in a recession. It's not how a home builder reacts in a a weakening housing market, bubble. To me, this is strengthening. Not only that, the regional banks look good, and they look like they're trying to bottom and come out of a Livermore accumulation cylinder. What I would say is this here. Here's your home builders. I'm going to take out log. This is your Jesse Livermore accumulation cylinder. That's what this is. 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7. And if we get a break here, all of the people calling for the housing market crash are going to most likely be incredibly wrong. And we've already broken the downtrend line. We've got interest rates that are coming back that I showed you on the 2-year here. And if these were to come back to a level down here, it's going to reignite the home builders and the housing market, in my opinion. If it does come back there, we can obviously watch it together on the channel. But that's what I see there in the housing market. This guy is similar to the same viewpoint that I've got. Now, I know people find comfort in having the same viewpoint, but my comfort is where I think interest rates could go in the short term, and where home builders are breaking to all-time highs. And I can take a bunch of different home builders. It's not just those. Here's Toll Brothers. We'll go logarithmic here. That does not look weak. That looks like a secular bear market here. The breakout, the retest, it's been sloppy. I get it. And here we are at all-time new highs. When do you make new all-time highs in a housing market bubble? These home builders lead the bubble lower. They don't lead a bubble, they're leading this higher. In my opinion, these guys are leaders and they're all leading us to levels that are much higher. And there's obviously better investments than these that I'm showing you. There's also other ones that have broken huge basing patterns to the upside, which makes me even more bullish on the sector. It says, what happens if, and I don't like these what happens ifs, but a year from now, mortgage rates fall to 5%, but house prices do not increase. This guy's going to be wrong. He's wrong because we're going higher in the home builders. It's going to go up. That's my opinion. And mortgages, the lock-in effect loosens up. This doesn't matter. He needs to go look at more data, in my opinion. He needs to see this and I'll say the footprints that the home builders are putting in the market and on these patterns are ridiculous. I look at this and then I read these charts or these opinions and I just say, holy crap, like these guys just don't look at anything. Like it's like a very obvious setup in a lot of these different charts. The fact that commodities are setting up the way that they are is another indication that we're in the same exact location like we were in 2000, 2001, 2002, where we pulled on back and we're starting to break all these things to the upside. Maybe it's 03, whatever. So here's Steve. Steve Harney says, explain to me how my math is off. If we look at the rent versus buy situation in residential real estate purely as a financial decision, shouldn't we include all financial aspects? If renting is $1,000 a month cheaper than buying, that means the renter saves $12,000 a year. But if you buy the median priced home in this country, $400,000, and it appreciates by the forecasted level of 3%, don't you get that 12% back in equity? Plus, you get the mortgage interest deduction and the property tax deductions on your taxes. And as a homeowner, you virtually lock in your monthly housing expense for 30 years while rents will continue to escalate. What am I missing? And he's not missing anything. I think a lot of people are missing what he is stating here. That's what I'll say there. Nobody could have possibly anticipated this. CPI versus the M2 money supply as it declines. But now we want to watch the M2 money supply, watch the housing starts, watch the home builders, watch regional banks, and watch interest rates. If they all start to move on up, we'll see the M2 money supply move on up. But again, there's been QT occurring, quantitative tightening. And that money has been coming out of financial assets. So they sell an asset, they take that money, and they basically take it out of the system when they sell that asset. And they keep the dollars. Now, are they spending the dollars? Is it coming back into circulation again? We'll see. But bank lending has definitely slowed down. That's going to have an impact on M2. And if interest rates come on back down, I think bank lending will come back up. Um, Here's Michael Burry. It says Michael Burry has closed his $1.6 billion S&P 500 NASDAQ short position for an estimated loss of 40%. Wow. I know a lot of people are trying to follow Michael Burry, and I don't know. I'm not doing what he's doing, but uh, I'm not going to short anything here, guys. They can print a bunch of money and override anything on a nominal term. So home builder stocks jump up following the CPI report and the 20 BPS step down in the 10-year Treasury yield. So interest rates coming down, mortgage rates, and you can see DR Horton up 5%, Leonard Corp, like we just went over, 5%, and Pulte Group 6.3%. These guys are all very close to all-time highs. So here, 52-week high, 132, we're at 128. 52-week high, 133, we're at 128 for Leonard. 52-week high is 87.38, and we're at 87.18, which is basically its all-time high. Very weird. And all these guys calling for a real estate bubble. Why are the home builders making new highs? Why are they right underneath their highs? Exactly. Imagine societal collapse at oil above $250 a barrel when food banks already have record demand and people are already struggling. That's coming. Get ready for it. Inverted head and shoulders. I did do a Palisades Radio interview. Check it out if you guys haven't. New Zillow forecast model predicts that U.S. home prices as measured by ZHVI will fall minus 0.1% over the next 12 months. Just 3 months ago, Zillow issued a bold 6.5% call. This is a sharp downward revision. What's going on? I don't know what they're trying to predict here. Over the short term, we'll find out what happens. I think the forecasts are all going to be wrong. I think it's really tough to forecast the short term here, and we just have to be patient. Glencore and two steelmakers buy the metallurgical coal business of Canadians Miner Tech Resources. Glencore will pay $7 billion for 77% of the business. On first reading, Glencore is paying a surprisingly small multiple for the business. Go Glencore. I actually like Glencore quite a bit. It's a diversified mining company paying a big dividend, and I think they're picking up assets pretty cheap at a very opportune time, in my opinion there. If we're going to do this, let's do it properly, shall we? Year to date, the 14 companies on this list spent $8.9 billion on buybacks as of October alone, down 60% from last year of $22 billion. And these are the people doing buybacks. Some of those companies at least I am invested in. Say that. This is the Australian dollar versus the Japanese yen. It's a weird looking basing pattern. I don't know if he's trying to say that that's an inverted head and shoulders. Whatever it is, if it starts to break higher, what it's telling us is that if the dollar goes down or the Japanese yen goes down against some of these commodity currencies, which it looks like they are, we could have a big commodity boom. And again, the currency markets are also signaling that we could see a big commodity boom, which if we have a commodity boom and these interest rates are weakening against the commodity currencies, that's more evidence of a real estate cycle boom. All of these are interconnected, and I would say it's almost impossible, well, maybe not impossible, but it's very highly unlikely that you've got a correlation between all of the currencies signaling a commodity boom, the home builders signaling a commodity boom. The interest rates are going to be moving based off of the rate of inflation in the short term. So high rates of inflation, interest rates will move up, lower rates of inflation, and it's going to cycle up and down as we go through this secular bull market. But the bottoming patterns in all these different ratios and currencies and everything are signaling that a commodity bull market is most likely coming. Investors are the most overweight treasury bonds since the global financial crisis. Investors are the most overweight in bonds in 14 years, expecting rates to decline, says a survey says. Peter says the Fed can't win an inflation war as any indication of victory will produce a sharp decline in the dollar's exchange rate. If the Fed ever declares victory in the war, the dollar will collapse. A weakening dollar will put renewed upward pressure on producer and consumer prices. Another one he says for Peter is a slowing economy will actually cause inflation to speed up. That's because the economy slows, budget deficits will rise as the dollar will fall. These developments will lead to even more inflation, which will push both long-term bond yields and consumer prices much higher. What do you guys think of that? What's your opinions? Put it in the comment section. Like to hear your opinions on what Peter thinks here. UBS predicts the Federal Reserve will cut interest rates by 275 basis points next year, almost 4 times what the market is currently expecting. That's interesting too. They expect rate cuts going forward in 2024, and I think that's just going to boost home sales. And I think that's also why the home builders are going up. And it's almost a direct correlation when rates go down and that unaffordability level. I think people have figured that out quite directly. This here, an unprecedented 8.2 trillion of U.S. government debt will be maturing in the next 12 months, or a third of the total treasuries outstanding. That is 3.5 times more than what was net issued so far this year. We have massive U.S. federal debt maturing over the next 12 months at much higher interest rates too. A good 75% of total SBSW, that's Siboney Stillwater, production cost is below current spot rates. And they have a very easy capital profile with almost no leverage and a third of the market cap in cash. But sure, the cheapest big mining company around is a falling knife piece of junk, as he shows the operating costs and a lot of the EGM presentations of Siboney Stillwater. And someone was making a comment about it. Hedge funds now have the largest short positions in oil since July. This is probably all going to unwind. Generally, when you get sentiment all on one side, it has to shift to the other side. So something else I'd like to, just share. But that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Use the word discount in the coupon code. And I think we're on the right side of this. We just got to be patient. Just wait. So that's all I've got for today. We'll catch you later. This is Finding Value.